Hey, it's Jin here from Power Broker. Today's date is January 15th, 2026. Silver just broke $90 an ounce for the first time in history. Not 90 adjusted for inflation, not 90 in some obscure futures contract, $90 spot price happening right now while you're listening to this. And if you think that's just another number, you're missing what's actually unfolding across the entire precious metals complex. This isn't a rally, it's a repricing. Gold hit $4,639 yesterday, shattering records that seemed untouchable just months ago. Both metals are delivering their best annual performance since 1979, and the velocity of this move is forcing institutional players who've spent years dismissing precious metals to completely rethink their positions. The question everyone's asking is whether we're witnessing the early stages of a generational bull market or the final blow off top before a spectacular collapse. Let me give you the immediate context. On January 14th, silver touched 91.55 before pulling back slightly to settle around 90.39. That's up 4% in a single session and over 41% in the past month alone. Year over year, try 195%. The metal has nearly tripled in 12 months, while most traditional assets have struggled to keep pace with inflation. Gold's trajectory has been equally remarkable, but in a different way. The yellow metal climbed to 4,639 on the same day, extending a rally that's added over 72% in the past year. What makes this significant is that gold typically leads while silver follows with greater volatility, but right now we're seeing synchronized strength that suggests something deeper than typical safe haven flows. The gold to silver ratio tells the real story. Back in April, you needed 107 ounces of silver to buy 1 ounce of gold. Today, that ratio sits around 57. That's a compression of nearly 50 points in less than 9 months, representing one of the most dramatic relative value shifts in decades. When this ratio compresses, it signals that silver is outperforming gold by a substantial margin, and historically, that kind of outperformance doesn't happen unless industrial demand or investment flows are creating genuine physical tightness. Now, here's where the narrative gets interesting. Most mainstream coverage attributes this rally to safe haven demand amid geopolitical chaos. And yes, there's truth to that. Federal prosecutors threatening to indict Fed Chair Jerome Powell over congressional testimony about a building renovation project. The Trump administration pressuring the Fed to cut rates. Escalating tensions with Iran, where the president warned of 25% tariffs on any country doing business with them. Military operations in Venezuela that resulted in the capture of President Maduro. Threats about annexing Greenland. It reads like a geopolitical thriller, not a normal policy environment. But safe haven flows alone don't explain why silver is moving nearly twice as fast as gold. The real force driving silver comes from its dual identity. Unlike gold, which serves almost exclusively as a monetary asset and store of value, silver functions as both a precious metal and a critical industrial commodity. And that industrial demand profile has fundamentally changed over the past few years. Electric vehicles use 25 to 50 grams of silver per vehicle compared to traditional cars. Solar panels require 15 to 25 grams each, with newer technologies using 50% more than older designs. Data centers powering the artificial intelligence boom need silver for optimal electrical conductivity in servers and semiconductors. There's no viable substitute for most of these applications because silver is simply the best electrical conductor available at scale. The solar sector alone is projected to consume over 260 million ounces this year as global installations surge toward multi-terawatt capacity. That's not speculative demand. That's physical metal being permanently embedded into infrastructure supporting the energy transition. When you combine electric vehicle adoption, renewable energy mandates, and AI infrastructure build-out, you're looking at structural industrial demand that wasn't present during previous silver bull markets. Then China dropped a bombshell on January 1st. New export restrictions limiting silver shipments to just 44 approved firms, effectively ring-fencing Chinese refining capacity for domestic use. China controls 60 to 70% of global silver refining. When the dominant player in any commodity market decides to prioritize domestic supply, international markets feel it immediately. Shanghai silver now trades at premiums of $8 to $10 over New York prices, a dislocation that would normally trigger arbitrage flows except the metal physically cannot move due to export controls. This is where the October short squeeze becomes relevant. During that event, borrowing costs for silver spiked to unprecedented levels as buyers scrambled for physical metal in a market where paper contracts vastly exceeded available supply. The market seized up, liquidity evaporated. And unlike gold, there's no central bank backstop for silver, no lender of last resort when inventories run thin. That structural vulnerability creates the potential for explosive price movements that overwhelm traditional risk management. What we're witnessing now looks like the continuation of forces that were temporarily suppressed but never resolved. Physical tightness combining with investment flows and geopolitical uncertainty, all converging on a market that's structurally smaller and more volatile than gold. The mechanics of how this plays out over the coming weeks will determine whether we're headed toward $100 or facing a sharp correction that traps late buyers. Here's the technical picture that reveals just how extended this move has become. The relative strength index on silver's daily chart pushed above 72 during Wednesday's surge, entering territory where corrections typically begin. But momentum indicators alone don't tell you when the reversal arrives. They just tell you the odds are shifting. Support now sits at $75 to $76, coinciding with the breakout level in the 20-day moving average. A clean weekly close above 80 confirms the next leg higher toward 90 or potentially 100 on a measured move from the multi-month base. Failure to hold current levels could invite a quick test of $72 on profit-taking or forced liquidation. Keep watching lease rates and backwardation. They're flashing red for acute near-term physical tightness, which favors anyone willing to buy dips. The gold to silver ratio dropped to approximately 57 to 1 as of mid-January. That's a compression of nearly 45 points from April's extreme above 100 to 1. When you see that kind of ratio shift, you're witnessing silver's explosive outperformance in real time. Historically, the ratio fluctuates between 50 and 80 to 1 during normal market conditions. We're now at the lower end of that range, suggesting silver was significantly undervalued at the start of 2025 and has been catching up aggressively. If gold holds steady around $4,600 and the ratio compresses further to 50 to 1, silver would need to reach $92. Push the ratio to 45 to 1 with gold at the same level, and you're looking at over $100 per ounce. The accessibility factor matters here. Gold at $4,000+ per ounce requires significant capital for even a single coin. Silver at $80 or $90 remains within reach for regular retail investors, which creates self-reinforcing momentum during bull markets as new buyers enter. Investment flows through exchange-traded funds have been relentless. Holdings in State Street's SPDR Gold Trust rose more than 20% this year, reflecting a broad-based shift toward hard assets. The iShares Silver Trust saw similar accumulation despite a brief 10% pullback in late December that served as a volatility reminder. That correction, the steepest since 2020, demonstrated how quickly sentiment can flip and how vulnerable leveraged positions remain to sudden reversals. But the dip got bought. That's the key signal. When corrections get absorbed within days rather than weeks, it tells you the underlying demand remains intact. The democratization of precious metals investing through ETFs has fundamentally changed market dynamics, bringing retail capital into spaces previously dominated by institutions and physical buyers. Currency debasement concerns underpin much of this investment demand. The United States government spent $1.8 trillion more than it collected during fiscal 2025. Another trillion-dollar deficit looms for 2026. The national debt just crossed $38.6 trillion with no credible plan to address it. When debt-to-GDP ratios exceed 100% across multiple major economies, investors start questioning whether currencies can maintain purchasing power long-term. The euro, yen, and pound sterling face similar fiscal and demographic challenges. Precious metals represent assets that exist independently of any government's balance sheet, making them attractive as portfolio insurance against monetary mismanagement. The CME Group's decision to raise margin requirements on silver futures effective December 29th added another layer of complexity. Initial margin for March contracts jumped to $25,000 per contract, forcing smaller traders to either close positions or face automatic liquidation. Margin increases act as circuit breakers during extreme volatility, but they also trigger forced selling that creates temporary price dislocations. The exchange's actions reflect just how volatile this market has become, with daily swings exceeding 5 to 10% now commonplace. Silver moves approximately 1.7 times faster than gold in either direction due to its smaller market size and dual commodity precious metal nature. Industrial demand accounting for over 50% of consumption makes it more sensitive to economic conditions, while lower liquidity amplifies price movements during thin trading. Expert forecasts span a wide range, reflecting genuine uncertainty about how far this extends. Larry Leopard from Equity Management Associates sees $75 by mid-year and $80 to $90 by year-end as realistic. Hao Hong at Lotus Asset Management suggests the rally has room to reach $150 by December. Robert Kiyosaki projects $100 to $200 while warning about fear of missing out mania. The spread between conservative and aggressive targets tells you something important. Nobody knows exactly where this tops. What multiple bullish conditions aligning simultaneously could produce, versus what happens if even one factor reverses remains the critical unknown. For prices above $100 to materialize and stick, you need industrial demand staying strong, mine supply remaining constrained, safe haven flows persisting, and no major policy interventions or economic shocks derailing momentum. The risk management question becomes central as we push into uncharted territory. Position sizing matters more now than at any prior point in this cycle. Over-leveraging into a parabolic move has destroyed more accounts than any bear market ever could. Professional traders emphasize taking partial profits at predetermined levels rather than riding positions to emotional extremes. If you entered silver below $30, locking in gains above 90 makes mathematical sense regardless of where the ultimate peak lands. The psychological challenge comes from watching further upside after selling, but protecting capital always trumps maximizing every last percentage point. Physical holders face different considerations than paper traders. Storage costs, premiums over spot, and liquidity constraints all factor into the equation. Premiums on physical coins and bars have expanded dramatically during this rally, sometimes exceeding $8 to $12 over spot prices. That spread works against you when selling unless you're transacting peer-to-peer rather than back to dealers. The tax implications of large gains also require planning, particularly in jurisdictions treating precious metals as collectibles with higher capital gains rates. Consult qualified tax professionals before making major liquidation decisions. The wildcards that could accelerate or derail this move deserve attention. A genuine credit crisis or sovereign debt default would likely propel silver far beyond current analyst targets as systemic confidence evaporates. Conversely, a coordinated central bank intervention to stabilize currencies and restore faith in the monetary system could trigger sharp reversals. Policy changes restricting retail investment in precious metals, though unlikely in Western markets, remain possible in certain jurisdictions. China's export restrictions demonstrate how quickly regulatory landscapes can shift. Technical levels to monitor going forward start with $95 as the next major psychological barrier. Breaking cleanly above that opens the path toward 110 to 120, where historical resistance from adjusted 1980 highs comes into play. On the downside, $80 now functions as critical support. Losing that level would likely trigger a retest of 70 to 75, potentially shaking out late entrants who chase momentum without conviction. The January 14th close above $90 represents a watershed moment that will be studied for years regardless of what happens next. Whether this marks the beginning of a sustained move toward 150 plus, or a blow off top before a major correction remains unknowable in real time. What's undeniable is that the structural conditions supporting higher price industrial demand growth, supply constraints, monetary uncertainty, geopolitical fragmentation show no signs of reversing in the near term. Gold's parallel performance provides crucial context. With gold establishing new records above $4,600, the entire precious metals complex is repricing higher in response to macro conditions that favor hard assets over financial paper. The correlation between gold and silver has strengthened significantly, suggesting both metals are responding to the same underlying drivers rather than silver simply catching up mechanically. The broader investment landscape has shifted fundamentally. Traditional 60-40 portfolios of stocks and bonds are being questioned as both asset classes face headwinds from elevated valuations and policy uncertainty. Alternative assets, including commodities, real estate, and cryptocurrencies, are capturing larger allocations as investors seek diversification beyond conventional instruments. Precious metals benefit from this structural reallocation while also offering liquidity and recognition that many alternatives lack. What separates this rally from prior cycles is the participation breadth. Institutional investors, family offices, sovereign wealth funds, and retail participants are all active simultaneously. The October squeeze demonstrated that physical demand can overwhelm paper markets when multiple constituencies compete for limited supply. That dynamic hasn't disappeared. It's merely paused while prices digest recent gains and new supply attempts to reach market. The path forward depends on factors both known and unknown. Industrial demand trajectories, mine production responses, central bank policies, geopolitical developments, and investor psychology will all play roles in determining whether silver consolidates near current levels, breaks sharply higher, or corrects substantially. Certainty is impossible. Preparation is essential. Understanding the drivers, respecting the risks, and maintaining disciplined position management separate successful participants from casualties. This moment in precious metals markets will define portfolios for years to come. Whether you're holding physical metal, trading futures, or watching from the sidelines, the structural forces reshaping global commodity markets and monetary systems are playing out in real time. Silver's journey from forgotten industrial metal to mainstream investment phenomenon reflects deeper questions about currency stability, resource security, and the architecture of the financial system itself. The answers to those questions will ultimately determine how much higher this rally extends and how long the fundamental drivers persist. The framework for navigating what comes next isn't complicated, even if the execution proves challenging. Watch physical premiums between Shanghai and Western markets. Widening spreads signal intensifying supply constraints that paper prices will eventually acknowledge. Monitor ETF flows for signs that investment demand is accelerating or reversing. Track industrial offtake data from solar installations and electric vehicle production to gauge whether structural demand remains intact. Pay attention to central bank rhetoric and policy shifts that might alter the macro backdrop supporting precious metals. Position management becomes everything in markets moving this fast. Avoid the temptation to predict exact tops or bottoms. Focus instead on risk-reward at current levels and adjust exposure accordingly. If you're holding significant gains, consider scaling out partial positions to lock in profits while maintaining exposure to further upside. If you're underweight or on the sidelines, waiting for pullbacks to establish support levels offers better entry points than chasing momentum at all-time highs. The reality is that nobody rings a bell at major turning points. Markets that feel invincible often reverse without warning, while moves that seem unsustainable frequently extend far beyond rational expectations. Silver at $90 feels expensive to those who remember $20 metal, yet it might look cheap in hindsight if the structural deficit persists and industrial demand continues absorbing available supply. What's clear is that the precious metals landscape has fundamentally changed. The assumptions that govern markets for decades abundant supply, stable currencies, predictable policy no longer hold. We're operating in a regime where resource nationalism, monetary experimentation, and geopolitical fragmentation create conditions favoring tangible assets over financial abstractions. How long this regime persists and how extreme it becomes will determine whether silver reaches $150 or mean reverts towards 60. The breakout above $90 isn't the end of the story. It's a chapter in a larger narrative about confidence, scarcity, and the search for value in an increasingly uncertain world. Whether you're positioned for further upside or protecting against downside risk, the principles remain constant. Understand what you own, why you own it, and under what conditions your thesis breaks. Everything else is noise.